In this video, we're going to be talking about tax planning in retirement. Specifically, we're going to be talking about why the taxes you're going to pay in retirement could be a lot lower than what you think. Your taxes in retirement will probably be one of your largest expenses, up there with travel, up there with investment fees. But if you're used to paying high taxes on your employment income, then you might be surprised to see how low your taxes could end up being in retirement. In fact, we see this question come up all the time. We see it come up from clients, and we see it come up from advice users who are building their own retirement plans. And they're asking, why are my taxes in retirement so low? Now, we love seeing this question because it really highlights the value of a detailed retirement plan. If you don't have a detailed retirement plan in place, you might be making certain assumptions about what your taxes in retirement will end up looking like. And you might end up over-saving, over-investing, or even delaying retirement because you're under the false assumption that your taxes in retirement are going to be higher than what they actually end up being. In this video, we're going to walk you through two examples. We're going to walk you through a couple example and an individual example. For the couple, we're going to look at pre-retirement and post-retirement taxes on $100,000 of income. And then for the individual, we're going to look at how their taxes changes in retirement. Now let's start off with the example of taxes before retirement versus taxes in retirement. So let's start with that pre-retirement example. We've got a couple, so we've got two partners here. They're earning a total of $100,000 of employment income. It's not split equally. We've got one partner earning $80,000, the other partner earning $20,000. Now, unfortunately, pre-retirement, we don't have the option to split that income. So there's no income splitting opportunity on that employment income. And the tax credits that they're going to be eligible for will be a little bit less. It's going to be the basic personal exemption. It's going to be CPP credits on their CPP contributions. But for the most part, they're not eligible for a lot of individual tax credits. So in total, we've got about $7,687 of tax credits. This ends up with them paying net tax of about $15,000. So on $100,000 of employment income, we've got net tax, income tax of about $15,000. Now let's take a look at what this looks like with the same $100,000, but in retirement instead. So post-retirement, post-age 65, this is going to look quite different. So here we've got retirement income. Now this could be RIF income, pension income. In this case, it's a mixture of RIF withdrawals, CPP, old age security, and each partner here has $5,000 of eligible dividends from a non-registered account. Now total is still $100,000, still $100,000 of income, but now they can split that income. So for partners in retirement, this is one of the main reasons you're going to have lower taxes in retirement than you did pre-retirement. So here partner one has maybe $50,000 of defined benefit pension income, maybe it's $50,000 of RIF withdrawals after the age of 65, and they can split up to half of that with their partner. So they can shift $25,000 of income over to their partner. This leaves them with $55,000 of taxable income and their partner with $45,000. So much better than that pre-retirement example where it was $80,000 and $20,000 of taxable income. So here they're able to split income in retirement, a huge advantage for couples as they get into retirement. Now they're also going to be eligible for additional tax credits. So many people don't realize this, but after the age of 65, you're going to be eligible for the age amount tax credit, a very generous tax credit. For both of partners, that's going to be quite a bit of tax savings in the tax credits as well. And if they have eligible pension income, they're going to get the pension income tax credit, also a generous tax credit. So that's going to lead them to have more tax credits than they did pre-retirement. It's going to help lower their overall tax bill. Now that net tax that they end up owing is $8,751. So on $100,000 of income, their average tax rate here is only 88.7%, $8,751. So if we look at pre-retirement versus post-retirement, same $100,000 of income, we can see that their taxes are actually $6,000 less. And if we think about that with the 4% rule, that means about $150,000 of investment assets that they don't need. So if they can anticipate this reduction in taxes, if they can anticipate that they're going to pay less tax in retirement, they can also save less. They don't have to save and invest quite as much because they know that they won't have such a high tax bill once they get to retirement post age 65. So that $6,000 tax savings every year is a huge benefit. And if you don't anticipate that, you're going to be working harder than you need to when it comes to retirement planning. Now, the second example that I want to show you is an individual. Now, you might recognize this case study from the previous video we did, the CPP break-even video. This is Mary. Mary's going to retire at age 60. And in the previous video, we were looking at CPP break-even points. But in this video, we want to take a look at the taxes in retirement. Now, Mary wants to spend $45,000 a year in the go-go phase, about $40,000 a year in that slow-go phase in mid-retirement, and about $35,000 a year in that no-go phase at the end of retirement. Now, if we look at Mary's income, we can see some drops here when income drops due to spending, but there's also a drop here in income at the age of 65, and this is due to a reduction in tax. So if Mary were completely planning her retirement based on that early retirement tax of about $8,258 per year, she might be grossly overestimating how much she needs for retirement because she may not realize that her taxes at the age of 65 are going to go down. So there's two main reasons for this. Unfortunately, income splitting is not an option for Mary, just an individual. So what we're seeing here is the age amount tax credit and the pension income tax credit, as long as Mary converts her registered RSP to a RIF at the age of 65. So these withdrawals are going to be eligible for the pension income tax credit. We get the age amount tax credit, and that leads to a reduction in taxes. If we hide all of these factors here, we can really hone in on that tax reduction. So let's hide all these, and let's take a look at that tax reduction. We're going from $8,225 all the way down to $5,825. 26, that's about a $2,400 reduction. So $2,400, if we use the 4% rule, that's worth about $60,000 in financial assets that Mary doesn't need because of the reduction in taxes post 65. So there's really only 5 years here where we're paying higher early retirement taxes, and then post 65, that tax number goes down, and then it goes down again when spending declines later on in retirement. But that's why we want to have a good idea of taxes in retirement. We want to do tax planning pre-retirement, because otherwise we might be over-saving, over-investing, and maybe even delaying retirement when we don't really need to. Now, my name is Owen. I'm an advice-only financial planner, a CFP, and the founder of Advice. Advice is an easy and powerful retirement planning platform that you can use to build your own retirement plan for just $9 a month. So if you don't have a detailed retirement plan yet, I would highly encourage you to go to advice.ca, sign up for an account, and get started on your retirement plan. Take a look and see how much your tax will go down from employment to retirement. It might be a larger reduction than you might expect. Thanks so much for watching. I'd love it if you like and subscribe, and we'll see you at the next one.